All right, Spencer Israel here with Benzinga. Got a really good interview for you guys today. I'm joined by two people, as you can see. Phill Rosen, who is the CEO of Even Financial, and Hilary Chidi. He is the Senior Vice President and Head of Product for Consumer at TransUnion. Phill and Hilary, thank you so much for joining me today.
Thanks very much for having us.
Phill, I'll start with you. Give me a quick skinny on your background. You have a history, a background in lending and as a software engineer. So tell us about how you got here.
So prior to Even, I was a technical co-founder of a company called Orchard Platform, and what we were doing there was actually running investments for institutional investors into unsecured lending. Buying debt, optimizing yield, really high-speed programmatic stuff. And we wanted to build a secondary market to enable retrading of it. But as we were working on it, it became really clear that the ecosystem and the infrastructure surrounding unsecured consumer debt wasn't ready to support that. There were just too many things missing around access to consumer data, financial health, that there was just this gaping hole in the ecosystem that needed another platform. So I left Orchard to start Even Financial to bring about infrastructure that could really connect the dots between all of these consumer-facing channels that were bringing new financial service products to bear and the institutional capital who wanted to acquire and engage with those consumers. And so that's what Even is, right? We're a platform infrastructure that sits between consumer-facing touchpoints and all the financial service companies and data providers like TransUnion to bring about a coherent, transparent ecosystem.
Right. So you're essentially a matchmaker, more or a middleman.
Between as a matchmaker. I don't really, a comparison I like to make is sort of almost like Visa or MasterCard, right? Visa and MasterCard is the network that merchants use to connect their customers to the banks to process payments. Whereas Visa and MasterCard do that for payments, Even Financial is building the same infrastructure for customer acquisition and financial service product distribution. You may go to a mobile application, let's say a Mint or Clarity Money or something like that and get financial help, but still you have to be connected to the products from SoFi or Lending Club or American Express. We're the network that does that connectivity. And it's not about an arbitrage like a traditional middleman would be. There are middlemen out there, the Lending Trees and Quinn Streets of the world, who go out and build a consumer brand and then try and basically sell those customers to the highest bidder. That's what a middleman does, and that's not what we do. We're a platform that's completely transparent, that delivers connectivity and optimizes outcomes for all constituents.
And then one of the firms you work with is a firm like TransUnion. So I'll bring Hilary on now. Hilary, how exactly did you get to be the head of product for consumer at TransUnion?
Sure. Thank you. So I'm actually a product manager by profession. I like to say I started out after undergrad working in consulting, but sort of gravitated towards product management at some point. But over the years, I basically have worked largely in product management. I worked in product management prior to business school. After business school, I took a detour, went to Goldman Sachs for a number of years, but then stayed in financial services. After Goldman, I worked at TIA for working in consumer products. And then from there, I moved on to TransUnion, where I have been focused on basically bringing consumer credit solutions to the marketplace.
Yeah, so let's just talk about the year that we've had here from both of your points of view. Hilary, we'll start with you. How have they been hit, and where are we right now in the recovery?
Yeah. Okay. The last part of the question is
big question.
Is hard to tell, and I look for hearing Phil's response to that too. But let me take the side of the question that I can answer. What has happened? It's looking at what has happened in the pandemic is really a story of two parts. 52% of, according to our hardship study, 52% of Americans have been financially impacted by the pandemic, right? They've had some impact to their household income, either in terms of lost employment or their reduced hours, or perhaps other ways in which their household income has been impacted, childcare expenses, and so on. So if you think about it, for that 52%, the impact is significant, right? It is, you know, these are individuals and families that are now desperately trying to make sure that they can continue to make ends meet, that they can continue to make payments on loans, they can continue to, you know, feed themselves, clothe themselves, pay rent, you know, pay their car loans, and so on. And in terms of what the impact is and how it's manifesting itself in the day-to-day, this is very significant, right? We're talking about people cutting back on discretionary spending, you know, which is the top way in which you see the challenges manifesting itself in day-to-day lives, right? And that's to be expected. So discretionary spending first to go. People cut down on perhaps the meals that they have away from the home, cut down on things that, you know, on things that they do outside of the home, which to some degree are already limited because of the pandemic anyway, to some degree. But then you also see the other ways that the pandemic is impacting behavior, right? So you now have an increasing use of credit cards by folks who fall within that 52%. So increasing the use of credit cards. And then I'll say the third way in which you see the most critical impact, it tends to be people basically tapping their retirement savings, which is probably the least recommended option. But when people find themselves in a very challenging situation, it then becomes just another means of survival.
I'm curious what the differences are in terms of different demographics, whether it be age, geographical, wealth. How does that impact how people have been impacted?
Sure. So one of the ways, I think it's actually it's pretty easy to actually see some of the connection points to some degree. People who are younger, for the most part, not necessarily in all cases, but in general, also tend to have less savings, or less in terms of less money put aside for challenging or difficult times. They tend to have less of a professional footing on which they can rely on when situations like this occur. So the impact the economic impact of a situation like the pandemic, unfortunately, will always disproportionately affect certain groups in society. And I'm talking about the younger populations. I'm talking about underrepresented, underserved minority groups. Those tend to be the groups that almost always are disproportionately impacted whenever you have a severe economic downturn like this. So in that sense, this is not very dissimilar from what you saw in the credit crisis in 2008 in terms of who got impacted the most.
Right. And Phill, you would probably have a little bit of a different perspective because you are observing, what the demand is like for all kinds of financial services, loans or whatever. So what are you seeing out there in the marketplace?
Well, I mean, there are a couple different Americas, right? I think Hilary was alluding to this, right? There's the younger generation. There's those minority communities who are less safety net and less cash saved. And then there's also Americans who are in pretty good financial place and their employment hasn't been impacted. And then there's the retirees who are living off of 401ks and have benefited from historically low interest rates for a long time. And who they are and it really impacts how they're affected. So certainly if you are a homeowner and you are in good shape right now, then there are very low interest rates out there to take advantage of, right? And so they're looking to the credit markets to actually improve their financial well-being. But that's not the majority of people, right? The majority of people have been impacted negatively. And so they're looking to credit products to really stay afloat. And that's really, really unfortunate. In some cases, these credit products can be used as an alternative to withdrawing from your 401k, which is something that's really not a good idea, as Hilary alluded to. But generally speaking, they're in trouble. And we've seen the credit markets and especially unsecured lending adjust to that as they've done more and more around employment verification, almost to the point where employment verification is as important as the actual credit score or the credit report.
That's right.
And then we've seen this affect financial service products outside of credit a great deal too. In times of uncertainty and in times of high risk, people look to protect what they have and to protect their family. So some things like life insurance, right, is really taking off right now. There's increased appetite by consumers to talk to financial advisors to help them actually get a handle on what is going on. So it's leading to increased appetite in many different places, but for different reasons. And depending on how badly you've been impacted right now, you may or may not have access to it.
That's part of what makes this such a strange time. Is it's objectively a really tough period to be in for everyone. But at the same time, there are certain pockets, of business, a few that you mentioned, Phill, and also like the housing market, for example, that are just on fire right now, and like the e-commerce market, which is on fire right now. So it's a really that adds to the confusion and the uniqueness of the situation. Hilary, did you have something to add?
No, I was just completely agreeing with where Phill is going, and in particular the comment that he made about the increasing importance of employment verification in the marketplace today, which also is one of the more significant industry changes that you're seeing.
Yeah, it was really interesting what happened around, I guess you could say, April. The lending industry knew that there was going to be a problem. They didn't necessarily know that the problem was going to be a lot of charge-offs or defaults or where the impact was going to be. But the one thing they did know was that they needed to improve employment verification and get a handle on that signal in a way that was much faster than they had previously. Because the turmoil facing the American employment market was just massive. And that's where most of the uncertainty was coming from. And it's been interesting to see how this has played out. Lending Club recently released a report showing that most consumers are actually prioritizing unsecured personal loan repayments over credit card repayments, which I don't think is something any of us expected.
Yeah, that's right.
What are the implications of that?
Well, I think that it might be a psychological trick, right? That they may be viewing a personal loan more like their mortgage and less like a credit card, where credit cards, your annual income is sort of like a butter to bread ratio if you don't have a lot of savings, right? You try and spread that butter going from the things that are most important to you to the least important. And at the top of that list is going to be food and rent. And then as the butter gets thinner and thinner, you get to your credit card payment. And the question was sort of where in that priority were personal loans going to fall? And it turns out it was higher than we expected in a crisis like this.
Yeah. No. So I think, first of all, I will have to steal the butter to bread ratio. I love that. But to add to the point that Phill is making, I think it's important as well, though, to note that the personal loan marketplace is also very different today from where it used to be. It's very different, in particular from, say, 2007, right? So let's talk about even the type of consumer that gets a personal loan, right? In 2007, 40% of borrowers were prime.
Yeah.
Right. Today, the majority are, above 53% are prime. So that in itself already, to some degree, indicates that the very makeup of the consumer base is different to begin with, which also, to some degree, necessitates that they will look at the product to some degree differently as well. And then the other point to note is that the uses of personal loans themselves have also changed, right? Just as you would expect with a changing consumer population, right? Where in the past it might have been merely to make ends meet or to bridge themselves between income payments or salary or wages. Now they're using personal loans for things like home improvements, solar installation, purchase financing. So so to the point that Phill is making, it's pretty clear that you can see how many consumers will probably put personal loans in the same category as they would other loan products like mortgages, more so than they would perhaps credit cards.
Hilary, in thinking about the transition of the financial services industry to more of an online focus, more of a digital focus, what has worked and what has not worked over the last 6 months in making this more of a digital first industry?
Sure. So digitization overall, if you look at this digitization across industries for the most part, right, digitization has occurred more fluidly and I would say more pervasively in some industries, more so and faster than it has in other industries, right? So let's actually approach the question first from why that has occurred, right? So there are some industries, right, information and communication technology, right, or media. Those and perhaps even professional services as well. I'll say those three, and particularly the first two, have significantly been ahead of where finance was, right? And there are a number of reasons why you can get to a number of reasons why this has occurred, right? Perhaps it could be the nature of the externalities, how regulated the industry is, the power that the incumbents have, and the ability to shape, the market evolution. But the bottom line though is that finance has not moved as fast as some of those industries. However, it has certainly moved faster than some other knowledge-based industries. Though it has moved faster than, say, at least from my perspective, it's moved faster than, say, education, manufacturing, and mining for sure, and perhaps even healthcare. It has moved faster than now, and of course, the pandemic is almost certainly going to accelerate digitization in healthcare. So we'll set that one aside. But going back to finance, why has it moved as quickly? And it's, like I said, a number of different factors: the influence of the incumbents in the marketplace, the fact that, for instance, it's a significantly regulated industry. Let's just pause for a second and just talk a little bit about that. Setting up a new digital bank, you will admit, is significantly different from setting up a new airline reservation booking system, or setting up a new, meal delivery, online meal delivery service, right? So what you can even bring to the industry in that sense as a challenger is already to some degree diminished. Now that's changing rapidly, but it's still the case. There are also certain, I'll say, not just cultural, but certain dependencies that the industry has had that have been hard to shake. So let me give an example. You find physical branches all over the place of banks. However, much of the foot traffic, many of the branches will tell you, are for things that are very mundane. And these are for things like notarization, people going in to notarize documents. Things that you can do online today. Actually, you can notarize online. I don't know how many people know that, but good luck trying to convince my mother to go do that, online, right? And so, for banks, there is the shift to moving fully digital or to going more digital is always impeded by a number of factors that I say that are from within the industry and from outside of the industry. Overall, in the past 6 months, though, you've obviously seen not just banks, just like every other organization, lenders, issuers, and so on, basically making great advances in how they engage consumers digitally. Overall. So I'll say in that respect, they are not different from other industries overall.
Yeah. And then Phill, from your perspective here, a lot's been written about the ramifications of the last financial crisis and what that had on fintech and how it maybe helped develop the industry in a way. And there are clear winners and losers from that. This time around, I don't know if I'm as concerned with who's going to win and who's going to lose, quote unquote. I mean, this is a tough time for all of us, but what types of companies are going to thrive in this sort of post-COVID world that we're in?
Well, going back to what Hilary was saying, the banks have a lot of I guess you could say, both regulatory capture and legacy systems and legacy methods in place, right? They have branches. They've largely operated on the assumption that they would own and continue to own a walled garden approach to the consumer. And over the last, say, 10 years, we've been watching sort of these internal battles play out within the banks between, I'd say, banking executives who want to protect that and keep core banking services really within the walled gardens, and executives who want to go and take an approach that's more distributed and embedded and in partnership with third parties and go outside that walled garden. And that is a battle that neither side has necessarily outright won. We've seen different amounts of progress towards getting a core banking function into an app or into a publisher or into a third-party system versus requiring you to pick up that Citibank app or that American Bank of America app, right? Do you believe that the ultimate state of things is going to be you have a single app from Bank of America that has all of your banking functions in it, and you're going to go to that and do every single transaction you ever need to do through that? Or are you going to consume financial services when and where you need it in the context you need it, right? And that is a conflict within the banks because they have to give something up to go that distributed and embedded path. This is acting as a forcing function, I think, to more of an embedded approach because there isn't a lot of ground to stand on if you're defending physical branches and if you're trying to say, no, we're going to maintain walled gardens. You need to enable access when and where the consumers can actually engage. So I think it's accelerating that trend a great deal. And I think the effect of that is also going to have a really synergistic effect with impact with the fact that all of these other companies who have inherent consumers, right, attached to their brand are looking to add financial service products, right? And looking to do it both because they can make more money that way, but also because they can deepen their relationship. Amongst the most premium companies prior to the pandemic, we saw Apple do that by adding a credit card in partnership with Goldman Sachs. Most companies aren't going to be able to go that path and are going to need to do it via something more like a co-brand experience, which is something that worked to great effect previously with credit cards, but needs to be different now, right? It has to be tech activated. Simply putting the Citibank logo inside a mobile app is not going to give the consumer what they need. You actually have to put the product there and make it consumable there. And that means that there's a lot of effort going into the technology to actually fully embrace this distributed approach to banking and partnerships.
And so, as a practical example of that, just TransUnion has brought Evans data, onto their platform and for their consumers. Hilary, I was hoping you could tell me about that decision and this partnership.
Yeah, no. So we're very excited about that. We're excited about that because of just what starting again about from the consumer's perspective, what it means for the consumer. And so for me, it's, the reason why we do these things is really about solving the consumer need, right? And so we see a tremendous amount of value in giving consumers or getting what consumers need in front of them. There are three things that I say that we really touch on very quickly, right? There's convenience, there's choice, and there's speed. So let me start with convenience, right? As Phill was just alluding to it a little while ago. Now we have consumers have a chance to basically find and get access to a range of products, be it personal loans or credit card products, wherever they are, when and where, when they want, and from wherever they are. They can basically, access these solutions. And choice, right? That's the other key thing now. This is also, it's a personalized solution in a sense, right? One of the things that Even has been great at is really working with us to ensure that we're able to give consumers a range of solutions that are best suited for them. From a product manager's perspective, like mine, it's I cannot extricate that from the consumer experience. If you come on our platform and you have the best product experience in going through the TransUnion platform, and you end up with a loan product that you are never going to qualify for, that you're never going to get access to, it's a bad experience. You can't, from a consumer's perspective, they don't know if it's, they associate, they don't see it as, oh, the TransUnion part of the experience was okay. It was only when I got to Acme Bank that it was bad. Like for them, it's one consistent experience. And so one of the things that Even has done is really kind of help us on that in terms of the choice and making sure that we're really getting consumers what fits their needs the best. And then speed is one of the key things for consumers, and particularly when we're talking in terms of personal loans as well, right? It's not just a matter of getting to the approval quickly, but it's also about getting access to the funds fairly quickly as well. And so when you think about the convenience, the choice, and the speed, this is really a fantastic partnership that we have with you.
So it seems like the main difference is static choices on the site versus real-time personalized choices on the site.
You could also think about it as difference between when you're shopping to go travel someplace, right? Are you going to compare Delta to American Airlines to Southwest based on their brands, or are you going to do it on how they're pricing the specific place you want to go to? Right? And are you going to do it based on the kind of experience they can deliver to get you there? Right? Those are two different modes of shopping. And one is very much the old way. And the new way is we all expect that we can go into Kayak and have something that's really personalized to our needs. But financial services requires a level of personalization well beyond just shopping for a flight, because anybody can get on the plane, right? But with a financial service product, most people, most loan products, right, are not suited for everybody. Right? And most loan products are suited for maybe 30% of those. So there's more to the personalization than just saying, oh, this is how much it costs and we'll get you to there in this time. And this is, the kind of snacks you're on the flight. We actually have to say, hey, can you get on the plane? Right? Is this actually something that we can actually sell to you? Which is a very big difference for financial service products in both credit and insurance. Not everybody can buy what they want to buy. And that introduces a lot of customer satisfaction issues that you don't experience in other types of digital shopping, right? Because there's nothing worse for a brand, for a consumer to come here and say, I want to buy this, and the brand say, sorry, we can't serve you, we're not going to sell to you, yes. Right? You don't want to be telling the consumers, no, we can't help you or meet your need. They're not going to come back, right? So you need to be doing something in a way where it's like, you can give the consumer what they need, even if it's not the first thing they ask for. And that is a hard thing, right? Because as we were talking about earlier, financial services in America is a very old industry. It has a lot of legacy systems. We have this crazy two-tiered banking system where every financial service product has the potential of being regulated differently in every single state. Okay, and then we have to say, okay, who's qualified, who's not, in a way that's very secure. And we're dealing with very sensitive data. So it's very hard to do that, right? No matter whom you are. And I'd say that, what we found at Even, and the reason we exist, is we think that this requires specialized expertise and technology in order to be able to deliver these experiences for our partners and clients.
And then before we wrap up, I just wanted to ask both of you, just like, what is one thing that you really are most excited or are hopeful for about how you'll be able to help consumers in the near term? Like what gets you most excited right now? What are you most hopeful about how we can come out of this crisis? And I'll start with you, Phill.
Yeah. So, one thing that's been interesting to see as, so the first wave of digitization was focused around a lot of credit products, right? A lot of things where you're lending money to consumers and charging them for it. And that's gotten very competitive. And it's created a sort of a situation where, companies are competing to sell debt, which could be helpful to the consumer, but it isn't necessarily always the best thing for the consumer. And I think that, part of that is because it's one of the few things that was really well digitized in the first place, was the ability to deliver debt solutions. The other things just weren't there. But as things become more digitized, what we're seeing is other products that are actually potentially long-term, more helpful to consumers potentially, are becoming more available to them, right? So we're able to bring to market more products that will help with savings and building credit and also education, because as they become more digital, they become more competitive for our partners to actually bring to market. And I think that's really important because, the fintech industry can't just be about selling these credit products. It has to be ultimately about helping the consumers on their financial journey to get where they want to be, which is ideally going to be something much better than where they are starting. And I think that this effort at digitization is going to really facilitate that.
And Hilary, to you now, what gets you the most excited, or what makes you the most hopeful about how you can help consumers pull themselves out of this crisis?
Yeah, so no, thank you, Spencer, for that question. I think I pay very close attention to some of the findings that we have in TransUnion's consumer hardships study, which we do to understand what's happening during this pandemic. And so one of the things that I find encouraging, at the very least, is that the percentage of people, or percentage of the population that is impacted is not growing, right? And is leveling off, or perhaps even decreasing. And that in itself is encouraging. I say it's also clear that the consumers in that study are very concerned about their economic well-being. They're very concerned about their credit health. I think there's an opportunity there for TransUnion, which we have we have really look to address in many different ways to ensure that we're providing very significant education tools and content for consumers around their credit well-being at this time. So really, tools and content that really kind of helps consumers understand how to manage their credit, particularly when, for instance, they have to make a choice between just perhaps paying down debt or saving, or they have to make a choice between paying down two different types of debt. Yeah. Perhaps, if you only have enough income to pay your mortgage or a credit card, what should you do? And certain decisions like that. So we've always had many of these tools. We are continuing to refine these tools. We're continuing to refine our content and to ensure that we can bring consumers some of the tools that they need to really address the needs. And overall, to the point that Phill was also making, I'm also encouraged and hopeful that as we kind of go through this pandemic and come out of it, the move towards digitization will accelerate, for the most part, access to financial services in a way that we haven't had in the past. And so the clearest point I'm making this is that for many Americans out there, the idea that people don't have access to basic banking services is almost incomprehensible. For them, they see bank branches when they go to the train station. They have an ATM machine at their grocery store. Many people even have bank locations in the buildings in which they work. But too large a population of this country do not actually have near access to banking services. They don't have physical branches that they can walk to. They don't have locations where they can actually engage in basic banking transactions. And so, and without that, they are really cut off from any other aspects of commerce that they will ordinarily be able to engage in. If you don't have access to basic banking services, guess what? You can do things, many other things in which that you and I take for granted. So as we move towards digitization, and I'm hopeful that in terms of access, some of these services become, truly ubiquitous and far-reaching, that it touches more of our society than it does today.
All right, Phill Rosen is the CEO of Even Financial. As you can see, Hilary, Chidi is the Senior Vice President, Head of Product for Consumer at TransUnion. I want to thank you both somewhat for the time today, and I guess keep on doing what you're doing, I guess.
Thanks so much.
Thank you. Thank you very much.